Thanks everyone for joining. I'll go ahead and get started. Um, Thanks again for joining. Excited for today's webinar because we get to talk about financing short-term rentals. It's one of the most common questions we get. So excited to dig in today with Chris Ledwidge from theLender because they're one of the more prominent short-term rental loan providers in the U.S. I'll give Chris a chance here in a second to introduce himself. Because they have a great short-term rental expertise, cover most of the country. But before doing so, I'd like to just go over the format of this webinar. So this one will be different if you've joined our prior webinars before, because during this webinar, we're actually going to be the ones asking questions. We are not financing experts, Chris is, so we asked Chris to join. So during this webinar, I'm going to play the role of an investor looking at financing options and ask him some of the top questions that are on my mind. I'll also include a few questions that we received from you guys prior to this call. So we'll do that for about 25 minutes or so. Then we'll do a Q&A from you guys for another 20 minutes or so before wrapping it up with a few special deals for you guys from both Rabu and from theLender. So please go ahead, use the chat feature to post any questions that you have throughout this call. Nicole and Chris Martel from our team, from the Rabu team, are going to compile those questions, summarize them so we can address them during the last 20 minutes of today's call. Hope that sounds good. I'll take that as a yes. Awesome. So to quickly introduce myself, I'm Amir Dukic. I'm the CEO of Rabu. We help investors like yourself find, buy, and operate short-term rentals nationwide. We do so by giving you data tools like data.rabu.com that help you find your next short-term rental investment. We also partner with groups like theLender and Chris here to help you as an investor buy the assets themselves. And then we have a management arm that can manage the property for you if you're looking for a passive investment. We currently manage about 400 properties nationwide. So that's us and Rabu. Glad to have everyone here. Chris, if you don't mind taking a minute to introduce yourself and theLender, please.
Hi, yeah, and thanks for having me. I've been looking forward to this conversation. My name is Chris Ledwidge. I'm co-owner and president of the retail division of theLender. And we have a very strong focus on real estate investors, specifically short-term rentals. So today I'm excited to talk about the different products that we have to offer the short-term rental investor, and also strategies that can be used when searching for these type of loan products and putting together the financing that can help you grow, buy your first short-term rental or grow into multiples. I'm a short-term rental investor myself, so the industry and all the verticals around it is something that I'm very fascinated with, and I love to learn more about it myself. And I love sharing the information that I've learned specifically in the area of financing to other short-term rental investors to help them achieve their goals of either buying the first or buying their multiples.
Awesome. Love that, Chris. Love that you're an investor yourself and that you saw that need for a financing need and decided to solve it through theLender. So great to have you. To get started, let's kind of address the elephant in the room, right? We've all been watching the news, following Twitter, hearing all kinds of negativity about the housing market and the economy, the rising interest rate. From your perspective, is right now the right time to finance an investment? And if so, what does the current financing landscape look like from your perspective?
I do think it's a good time for those investors out there to continue on with their strategies, and this is why. Right now, we're in a bit of a softer housing market, right? And we have more leverage as a buyer to go out and negotiate on these transactions, right? And when you have this negotiating power, you can implement different strategies on seller credits to help pay for closing cost or improve the terms of your loan that you won't have when it's a seller's market. I'll give you an example. Let's say you wanted to buy a $500,000 home today, and you want to go in and negotiate maybe 10% off that sales price, bringing it to $450,000, right? Rather than taking all your leverage as a buyer and going in and negotiating off the price, I would say go in at this time and negotiate maybe 5% off the price, bringing it to $475,000, and asking that seller for a 5% seller credit. And then using that seller credit to pay for your closing costs, keeping money in your pocket at the close of escrow, and then using some of those seller credits to, again, structure your loan in a way that's going to meet your immediate goals of financing and maybe even long-term goals of financing. That's why it's a good time to invest right now. You as a buyer have more leverage than you did 6, 12, 18, 24 months ago. Now, I would say that window is closing, right? So if you want, now is a good time to buy. That window of leverage is closing. If you look at some of the data points that are precursors to where this market's going, we saw about a 28% jump in mortgage applications last week. Okay, so what that is the momentum building right now for buyers to go out into the market and purchase homes, right? More demand is going to create more of a seller's market. On top of that, inventory is not expected to grow substantially this year. We have a bit of a phenomenon where a lot of the people that own these homes are sitting on 3, maybe 4% interest rates, maybe even lesser than 3, and they don't want to break those terms and go out today and end up with a 6% interest rate on that primary residence. So they're not going to be sellers. Move up buyers in this market are going to be depleted, which is going to affect inventory, which I think is good for all of us because that will help protect housing prices from sliding too much. But again, if that inventory is low and we see an increase in buyer demand, you're going to lose your leverage as a buyer. So I think that window for buying might be 90 to 180 days, about 3 to 6 months, where we're still seeing pricing concessions being given by the sellers of the home, negotiating off of sales prices, listing times being longer on market. As far as the financing landscape, I think I thought about this question a little bit, and if we were to look at the mortgage industry as a stock, I think we have hit the bottom, right? And we're starting to climb our way out on these financing programs rates. I'll explain why. If we in fact hit this soft landing that the Fed's talking about, and we see the base rates on the Fed side come down a little bit, that's going to impact rates obviously to the consumer. But the other end of that piece, which isn't really talked about a lot, are the credit spreads. Not everything's going to be tied to that Fed rate, right? The price of your loan or your rate also takes into consideration credit spreads, things like your FICO score, the loan to value on the subject property. What type of subject property is it? So in a market like this where there's a lot of volatility, those credit spreads tighten. You see loan to values drop. You see FICO requirements increase, reserve requirements increase. So if we continue to hit this soft landing, we see some stability in the economy. Investors that are buying these loans on the secondary market are going to open up those credit spreads. They're going to increase the LTVs. The cost of that loan from a credit perspective will decrease. So I think from that perspective, an opening of guidelines, a softening of the credit spreads in the Fed, I think we're looking at a good trajectory for the financing.
Love that, Chris. That was incredibly helpful. Yeah, of course, it makes sense, right? We're no longer in an environment we were in 18 months ago where, you were paying 20, 30% over asking to buy an asset. Now you can actually get a property below asking price, and you can then leverage that to reduce kind of some of your impacts across the board, even from your purchase price to your financing terms. Really, really good point. I appreciate that. This is a question that actually came in from a Twitter user prior to this call. So let's say I'm browsing through data.rebu.com and I come across a property like this one in St. Simon Island, right? I look at the numbers. I'm attracted by the 13.5% cash on cash return, by the fact that it's a 10% cap rate. It's exciting to me. But from here, I'm like, okay, what are my different financing options that I have for this asset? And what are the pros and cons of each? Because I'm not sure that I can go to Bank of America and say, hey, Bank of America, give me a loan for this property. I want to use it as a short-term rental, right? Like what are options out there to buy an asset that's really a short-term, specifically used as a short-term rental, like I potentially would for this one in St. Simon Island?
Yeah, so the 3 most common assets that I'm seeing being used by the STR owner operator, it's really 3 loan products. Now, there's going to be the Fannie Mae second home mortgage. Within those guidelines, it does allow for that property to be leased out on a short-term basis. That is written in their guidelines. Now, with the Fannie Mae second home mortgage, your down payment requirement is going to be 10%. That's what we'll talk about, maybe put it in pros and cons. Fannie Mae second home mortgage, 10% down. You're going to have a lower rate than you would on some of these alternative investor loan products. Okay. And then you also have no prepayment penalty. Most of these other alternative investor loan products are going to have some version of a prepayment penalty on them. So with the Fannie Mae product, you don't. That's an advantage. Now, a disadvantage to the Fannie Mae second home mortgage is it's going to be a full income doc underwriting, meaning we're going to look at your tax returns, pay stubs, W-2s, et cetera, in order to qualify you for that loan. And we have to be able to income qualify, meaning your debt as compared to your income cannot be greater than 45% on that type of loan. So, and then you cannot close in an LLC on that type of loan. So if you're an investor that has intentions to close in an LLC, maybe because you want to exercise certain tax strategies like cost segregation, depreciation, you won't have that option right out of the gate on a Fannie Mae second home mortgage. Now, beyond that, the most common product that is being used is the DSCR loan. Now, a DSCR loan stands for debt service coverage ratio. And with the DSCR loan, we're not looking at any of your income or your employment to underwrite that loan. Instead, we're looking at the subject property in a purchase transaction. We're looking at the subject property and we're determining what that rent potential might be. And then we give it a 20% haircut. So say it's $100,000 a year on the RABU estimated or annualized rent potential. We're going to give it a 20% haircut. And then now we have $80,000 to work with to qualify that purchase. Now, the question is, will that $80,000 divided by 12 cover the monthly payment on that mortgage, principal, interest, taxes, and insurance? And if it does, we're good. That's the whole purpose. It debt services, right? The property will debt service the mortgage. Now, some of the pros with the DSCR loan would be flexible terms. You're going to have, ARM products, you're going to have fixed rate products, and you're going to have interest only options. So if you're looking to get into a property and you want to maximize cash flow, you'd probably do a 7-year ARM with an interest only payment, right? That thus bringing down the payment to absolute lowest possible. Or if you're in a market where rates are really good and you feel like this is the time to secure a principal and interest payment, you can look at a 30-year term or even a 40-year amortization term on a DSCR loan, which is a very unique term, right? Stretching that payment over 40 years might get you into the numbers that you're looking for this investment. And you can close in an LLC. So that's another benefit of the DSCR loan. The cons of the DSCR loan is really going to be the interest rate is going to be slightly higher. And then you're going to have a prepayment penalty on that. And later, when we talk about strategy, I'm going to teach you and give you some suggestions on how you can navigate and negotiate your way out of that prepayment penalty. Now, the third option that's available out there to real estate investors, particularly for the self-employed real estate investor, is going to be a bank statement loan. Now, it's not uncommon for the self-employed individual to have tax returns that don't show enough income to qualify for that conventional or more traditional loan. So the bank statement loan works in the sense that we don't look at the tax returns of the self-employed individual. We're going to look at the last maybe 12 or 24 months of their bank statements from their business or personal account. And we're going to average the deposits or income into those bank statements over the last 12 months and use that as the income to underwrite the file. Now, when using a bank statement loan to purchase an investment property, we also get the added benefit of using the potential rental income from that subject property in that income calculation. Benefits of the bank statement loan, it's going to be a slightly lower rate than the DSCR loan, and it starts with a lesser prepayment penalty, right? And I'll put that into terms. A prepayment penalty on a DSCR loan typically starts at 5 years, but you can negotiate to 0. A bank statement loan starts with a prepayment penalty at 3 years. So the cost to negotiate from 3 years to 0 years is considerably less. And so those are the 3 products that are out there kind of serving all of the different types of STR investors, whether you're a full income doc qualifier, no income, no employment qualifying, or a self-employed individual looking to invest in real estate.
This is incredibly helpful. Chris, how would you categorize these? I mean, to me, and I could be wrong here, it sounds like Fannie second home kind of loans are usually really more used for your traditional second home, right? Like, hey, I want a property that I'm going to stay at in Myrtle Beach or something, right? Do you see them utilized by investors much, or is it really more utilized by individuals looking to buy a vacation home that they plan to utilize themselves? Because the DSCR and the bank statement product definitely see much more investor aligned, right? Is that correct? Is that a correct assumption?
That's 100% correct. The DSCR. So if we were going to categorize them, the Fannie Mae product is what we call a QM product, qualified mortgage, right? It has to fit this box. It cannot go outside this box. The DSCR and bank statement loans are categorized as non-QM. So we're allowed to go outside the box on certain things like closing in an LLC, using bank statements to qualify, using rental income to qualify. I see more people that are trying to get in for the first time using the Fannie Mae product. But I will say very quickly, more often than not, the ability to use that product is extinguished because of debt to income ratios, right? It gets very hard to use that product. So if you're going, onto your second, third, or more on STR properties owned, chances are you're going to fall into that DSCR bucket or that bank statement bucket.
Got it. That makes a lot of sense. And we're having a couple of questions come in. I think some of these are related, including one that we got ahead of this call. The first question that we got ahead of this call, which I think I can answer now based on what I just learned, but and this one came from Lenny, we got this via email prior to this call. Lenny's question was, what type of financing do you recommend for investors hoping to deploy the least amount of cash up front? Sounds like that's the Fannie second home, right? Because that you can do for 10%. Correct. Is that correct? That awesome. Correct. And then the questions that we're getting in the chat are around what is the percent down? What's the down payment percentage for both the DSCR loan and then for the bank statement loan? What would those be?
For DSCR, for a short-term rental purchase, the minimum down payment is 25%. We do 20% on exception. In order to get that exception, we're going to look at things like how much does the borrower have in reserves in the form of cash after close, right? Typically, minimum is 6 months. If you have greater than 12 months, that's great. So that's one of those compensating factors that we'll look at when making an exception like that. We look at the credit profile of the borrower. What does their credit utilization and their FICO scores look like? And then we're going to look at their experience as an investor, right? Or if they have, 2+ years managing investment properties, not necessarily STR, but investment properties in general, right? That's going to help. And then we're going to take a hard look at the subject property, right? Based off of that short-term rental income projection that we came up with, right? The annualized minus 20%, what is the DSCR ratio on that, right? Is that, and typically what I'm seeing, even with a 20% haircut on the annualized rental projection, that the DSCR on these type of loans is coming in at 1.15 or 1.25, right? Like 115% of the mortgage or 125% of the mortgage, because these things cash flow so well. On a bank statement loan, it is 20% minimum down payment.
Got it. And do you have one just real quick question related to bank statement loans? What are some of the cons again for the bank statement loan?
Con, it's going to be a slightly higher interest rate than the Fannie, but slightly lower than the DSCR. Cons on that one would be there is a debt to income ratio component, right? We are going to look at your debts and compare those to the income that we came up with by analyzing your bank statements. Not necessarily a con, but it is a prerequisite or requirement qualifying for that program.
Awesome, great stuff. So if I'm now, okay, this all makes sense. I found a property, I like this property. I'm going to make $14,000 a month on it. Feel like this is going to probably cover the DSCR ratio, just high level looking at it. But I'm intrigued. What are the things that I need to look for when I'm actually looking for the right lender to partner with for the first time? Like, what are some considerations that investors like myself should consider when weighing their financing options on who they work with, besides if they can provide a loan?
Yeah, so I think you want to, talk to many, but when you're talking to these lenders, you want to ask them specifically, how many investment property loans have you originated and closed in the last 90 days, right? And these loans have nuance to them. These investor loans certainly have nuance to them, and there's not a massive amount of people that are well versed in it. And what we've seen from an industry perspective, as refis went away and as production dropped for the everyday loan officer, they've had to pivot and find a way to try and make up that production. And so right now in the lending space, the investor loans, there's a market there. So we've seen a massive amount of people swing their focus in their business, going from a refi type loan officer into an investor purchase transaction type loan officer. And there's going to be a learning curve there. So ask them, how many investor loans have they originated and closed in the last 90 days? Hopefully that number, over the last 90 days is north of 15, right? You want to hope that they're getting those type of reps, which would be a good indication that they know what they're doing. And then you want to clearly understand the cost of their service. I see a lot of people that will come to us and they're shopping us as a lending partner, and they're saying, well, I got this quote from this lender, and I'm said, great, send it over. We're all about competing. And then they'll forward me an email that they have from some loan officer that has it all typed up in the body of an email. That's very inefficient in the sense, like, there's no APR, right? And then if you're going to look at one metric for the cost of that loan, look at it on an estimate that includes the APR, right? And then typically you're not going to see that in the body of an email, right, from some loan officer. So understand the cost of your terms, discuss those and shop those, right? And then just make sure when and just forward it to the other investor, get to the best terms and say, can you compete or not? So I think that's a good way to shop your mortgages. And then program options. When talking to that person, if they're only talking about one product, and they're pushing you that direction and not really asking you the right questions, you might end up in the wrong loan, right? And what I mean by that is you might come in and, I talk to you and you have all the intentions of learning more about a DSCR loan, but throughout our conversation, because I'm asking the right questions and getting to understand your situation, right? From an income perspective, an asset perspective, a credit perspective, and your goals as an investor, right? And being able to understand those goals as a STR operator myself, I might say, hey, look, I know we've talked about DSCR, but let's talk a little bit about the bank statement loan and why I think that makes more sense for you, right? So working with a lender that has, more than, just one loan program offering for investors is going to be important.
Awesome stuff. That makes all the sense in the world. Obviously, it's equally as important for you as the investor to interview the lender, not just settle for the first thing that comes across the board, because there needs to be a fit, right? And you make sure that there's no markups hidden along the way. Makes absolute sense. As an investor, I like to be efficient, right? I like to be prepared before I approach a lender about getting, financing. So with that said, what are the type of data points that lenders like yourself care about when looking to do a short-term rental loan? What are the most important things for you guys?
So every lender is going to look at these four fundamentals when underwriting a loan. We're going to look at the income, the assets, the credit, and the collateral. Now, in this case, if we're looking at an STR transaction, when I say income, if we're looking at a DSCR loan, we're going to look at the RABU data, right? We're going to look at the pro forma on that subject property.
We're sorry to interrupt you here. So like this revenue, our revenue estimate for this property here of $14,000 per month, right? Yeah. Is that what you mean by income?
Exactly.
Got it.
Using this data that RABU is aggregated, right, and comparing it, against other like subject properties, and we're using that to underwrite the income on the loan. Bank statement loan, we talked about that. We're using the bank statements on a Fannie product. We're going to do full doc, pay stubs, W-2s, tax returns, the whole deal. From a credit perspective, we're looking at the individual's, credit rating, right? Like, what's their FICO score? What's their credit utilization like? Do they pay their bills on time? Do they let things go to collection? Is there any derogatories in their past, like foreclosure, bankruptcy, short sale, things like that? Assets, we're looking at what type of assets you're bringing into the transaction, where those assets are coming from. Are they your funds? Are they gift funds? How did we source those funds? And then we're looking at the assets after close. How much does this individual have in reserves, right? And then the last thing we're really looking at is going to be the collateral. That's going to be the subject property. We're looking at, the fair market value through an appraisal. and determining that what we're lending against is being purchased at fair market value. And so those are the four things that we're looking at. And also in the appraisal process with the Rabu data, we get comparables. So we're able to quickly analyze it from that perspective as well. So, income, assets, credit, and collateral.
Amazing. And we have another question that was sent in prior to this. And I think you alluded to this earlier, Chris, but this is a question we got from Chris H on Twitter. On the income piece specifically, how do you calculate that, especially from a DSCR perspective? So you have that number that you generated through Rabu with the 14,000 at that property I just showed in St. Simon Island. How would you calculate the income piece for that particular asset, for example, or any asset that's looking to do a DSCR loan?
So we would take that monthly income amount, we'd look at it from an annualized perspective, right, over the course of a year, because there is seasonality in properties. And we're going to take that annual rental projection income, and then we're going to give it a 20% haircut, and then we're going to divide the remainder by 12. That becomes the monthly income we compare against the principal, interest, taxes, insurance payments.
Right. So that property I just showed, I think the revenue projected by Rabu was about $14,000. So we would multiply that by 12. So that would give me 168,000. Take a 20% cut off of that. So multiply that by 80%. That gives me 134,000. And then divide that by 12 to get to basically 11,200 as income that would qualify in this instance for the loan itself. Is that right? That's
precisely correct.
Awesome. Another question from Twitter. This one came from Chris K. The other was from Chris H. What questions do you recommend investors ask lenders when inquiring about STR loans specifically?
If you're inquiring about an STR loan, specifically like a DSCR loan, ask them how they determine the rental income on the subject property. Do they determine it through a data tool like Rabu and use that? Do they determine the rental income from the subject property with a 1007, which is an independent third-party rental survey? And what type of haircuts are they giving that income, right? Some people will give it a 25% haircut, only using 75% of it, and go that approach. Now, one thing I actually failed to mention as far as methods for determining the rental income on the subject property, if outside of the Rabu data, we do have the ability to look at the actual income data. So if in fact the subject property being purchased is a rental property, and we can get 12 months history on what that rental income is on a ledger from either a hosting platform or a property management company, we can use that income to qualify the new buyer on that subject property.
That's a great point. And for that type of asset, do you take any cut off of that like you do with the projection data, or do you actually use the full revenue generated?
In that situation, because we're getting a ledger with the full history, you're going to see the net operating income, and that's what would be used, because typically in a ledger from a property management company or a hosting platform, you're going to see the fees off of the gross. And so,
yep.
In that case, on that type of ledger, it's usually there in that, and therefore we use the gross minus the actual ledger deductions.
Makes sense. Good stuff. Yeah. Never hurts to have historical data for sure when it comes to trying to acquire a loan. Next question, and we've had a few come in related to this. Obviously, in this real estate environment, there are some opportunities to be creative and have some cost-saving opportunities that you can deploy to save money during acquisition. We had a couple of people ask about, how seller credits exactly work, but what are some of those cost-saving opportunities there in the current market? Seller credits being one of them. What else is there?
So there's a seller credit we talked about, which is available right now that, again, you can use that seller credit to pay for all your closing costs. You can use it to prepay HOA dues. You can use it to buy out the prepayment penalty on your loan. You can use it to buy down the interest rate on your loan. So there's the seller credit strategy.
Just to quickly stop you there, Chris, because we had a question about how seller credits actually work.
Oh, okay. So
I guess maybe if I try to, maybe I can try to explain it. Let's see if that works, right? A seller credit is basically a part of the negotiation that you would have when you put in an offer on a property. They'll say, hey, I'll pay you 2% below asking, but as part of that, I also want a 3% seller credit. So another 3% off the price that you can then use as part of your closing activity to pay other costs that are associated, whether, as you said, it's paying down any kind of interest rates or any points, whether it's paying HOA dues. It's really just part of a negotiation that you have when submitting an offer for the property. And that's all done at the mechanics of it are executed at closing.
exactly. So when that seller of that property is, getting the money, right? They're getting the proceeds from the sale of that transaction, it's going to be minus the credit that they gave you for the transaction, which is applied to your closing cost and other fees.
Yeah, makes sense. Okay, thank you for clarifying that. So besides seller credits, what are any others?
I have two that I think are advantageous at this particular time. One of them is going to be a 2-1 buy down. Okay, now the 2-1 buy down does not work on the DSCR loan yet, but it is available on the bank statement loan. It is available on conventional financing. Now the 2-1 buy down works in the sense that, let's say you locked your interest rate at say 7%. But in year one of that loan term, you're going to get a 2% reduction off of that interest rate, essentially paying at a 5% interest rate. Year two, you're going to get a 1% reduction on that interest rate, effectively paying a 6% interest rate. In years 3 through 30, you're going to be making that, you're at that fixed rate term of 7%. Now, the seller credit, in order to negotiate that correctly, you're going to want to or need to get seller credit. And essentially, we're using that seller credit to subsidize the interest payments on your loan in those first 2 years. Now, those savings can be significant. Obviously, the higher the loan amount in a rate environment like this, where rates are high, that 2% difference in year one is going to be substantial. Now, the only way this works, where it actually impacts your dollars and cents, is by negotiating seller credit to pay for that. I really like the 2-1 buy down as an option right now, as far as 24-month cost savings once you get in the property. And the other one that's available, which this one's available on DSCR loans, is a seller carry, right? So let's say that you have 10% to bring into the transaction. You don't income qualify for a Fannie product, but you don't have the 20 or 25% down payment requirement for this STR purchase. If you find a subject property that the seller is willing to carry a portion of the mortgage, you can use that to cover the remainder of the down payment, right? Now, let's say we lend to you at 80%, and then the seller carries 10%, and then you come in with your 10%. The seller would take a second position behind us in the mortgage, and then you're into the property.
Makes a lot of sense. Great insight there, Chris. Really appreciate that. Learning a lot. I know you and I have a couple more questions we're going to ask here, and maybe I'll finish with one, but I've seen a couple dozen questions come in, and I think we should take some time to answer. So this one, because I believe it's important. If I'm an investor looking to deploy capital, what are some mistakes or misunderstandings that you often see when talking to somebody like myself that you just would want me to be prepared for, so that I don't make them, so that I can actually close on this property and buy my STR?
I think the most common mistake I see is people that come in that aren't prepared, and then they enter into a contract, there's a deadline, and then they're getting stressed, and it's just not a good experience. And I think, how do you fix that? It's just by being prepared. It's about doing your due diligence, right? I think if you plan to make a transaction in the next 90 days, the first thing you're going to want to do is really do your research on Rebu, find the subject property, and pick one, and then contact a lender. And then when you contact them, say, hey, this is the property that I'm considering. I'd like to get pre-qualified for a DSCR loan before I put in an offer. So just being prepared for that before you put in the offer, having a lender look at your credit, have a lender review the subject property, essentially pre-underwrite that loan as compared to the terms available on a DSCR loan. So you know when you get in there, you're prepared to go. Now, if you're an investor, the other thing I see, which is common, if you're an investor coming in with the intention to close in an LLC, have all that paperwork buttoned up before you apply. I see a lot of people that come in, they found the property, they want to move, they get pre-approved, they intend on closing in an LLC, and they're chasing that whole process through the escrow. And then we're getting to the end, and then it just makes it very hard and between title, escrow, lender to get all that information coordinated correctly if it's not there up front. So be prepared, have your asset statements in ready to go, have your subject property information ready to go. And if it's an LLC, make sure that's in order.
Awesome stuff. Really appreciate this, Chris. Actually, one of the first questions we have on the list from the attendees is, it's a good segue. So what is the qualification process if you buy a property under a private business identity like an LLC? Do you look at business credit too?
No, we do not. We're looking at from the entity itself, we will allow for 4 members of that entity to, in order to do a DSCR loan. It can, I guess in other words, it cannot be greater than 4. And we're looking at whoever the member, whether it's 1 or all 4 that are applying on the mortgage, we're going to look at the applicant's credit, not the business credit.
Got it. And again, just to confirm, as an LLC, you cannot get the Fannie Mae second home loan, right?
That's not close a Fannie Mae second home mortgage in an LLC.
Let's see. Yep. Makes sense. All right. One question here is, if someone is sitting on $500,000 right now, would you recommend someone utilize these DSCR loans to get into more properties, or buy one, paid off, and cash flow this? Obviously, this is might be more of an accountant, financial planner question, but anything you want to chime in there, Chris?
So the question is, if I have $500,000, do I finance a portion of it or do I buy cash, right?
Correct. Yep.
I would not pay cash. I would finance, because that financing, at the end of the day, when you boil it down, through write-offs, taxes, and all that stuff, if you have a good CPA, and then you're holding on to that rest of that cash that you can deploy, that's going to earn for you, I think you're going to be able to reach a lot further. You invest that all into one asset, it's tied up in that one asset. Yes, you're cash flowing a lot better right out of the gate, but you're now on the sidelines on future investment strategies.
Yep, makes sense. Next one, can you get lending on land?
You can get lending on land. That's not one that we offer. Typically, land loans, smaller regionalized commercial banks, and then hard money lenders that are going to be close to the region that the land exists, right? Hard money lenders don't typically like to go out of state. There's very few that will. So when looking at a land loan, you're going to want to look for, either a hard money lender in your network or region, or look for a smaller privately owned commercial type bank.
Good stuff. This next one is good. It's a good one. What do you use to calculate the pro forma or the projection? Rabu, AirDNA, others have brought up. What do you guys use at theLender?
We're using Rabu.
Awesome. Always love that from our perspective. Next question. What fees does the lender have? The programs you're mentioning are available through majority of lending institutions. So I'm not sure is the case, especially on the short-term rental side. So the question is, what makes the lender stand out?
That's a great question. So let's understand where and how you get these non-QM loans, right? Non-QM loans, the vast majority of non-QM loans, DSCR bank statement type loans, are originated through broker networks, right? I'd say about 95% of them. There's very, very few outlets that lend non-QM that have a consumer direct division. theLender is one of them, and I think there's about 2 or 3 others that are out there. Now, when you go through a broker, the broker is going to charge a broker fee, a cost to you for them originating that loan and sending it to a company like mine, theLender. Now, as a consumer, what you can do is find these consumer direct outlets, right? Essentially skipping the broker, going directly to theLender and working with our consumer direct team. And the reason that it's going to pan out for you in the sense that we make our money as a lender by funding and selling these loans. Okay, a broker makes their money by originating fee for the service. Now, by coming to us, we're able to compress margins on the front end and the back end and pass through lesser cost up front and sell the same rate, the same terms that a broker will, but pass through lesser cost up front because we have two revenue streams and we can compress that. This is not a new strategy. You look at companies like Rocket Mortgage or Quicken Loans, they've been exercising this for years because when you call the company directly, there's a lot less cost in producing that loan, right? Therefore, they can pass it on to the consumer. When you work with a self-generating loan officer, whether it's retail or broker, they're bringing in the business, therefore they need to be compensated for that, so that it increases the fees. So by going consumer direct in some of these outlets for these products, it's going to save you money.
Love it. Makes all the sense in the world. Transparently, I'm not aware of many lenders that do provide short-term rental loans. So I think you guys definitely stand out for that. This is a quick one. Is there PMI for the 10% down Fannie loan?
Yes, there is.
Awesome. Basically, kind of the rule of thumb is anytime it's below 20, you should expect to pay PMI. Right.
That's correct. And in this, if you're looking at those products and you want to get rid of the mortgage insurance, again, if you can negotiate seller credit, you can use that seller credit to buy out the mortgage insurance up front. It's going to be probably anywhere from 2 to 3 points, depending on your credit score. But if you can get 2 to 3% from the seller and use that to buy out your MI, that's going to drop your monthly payment.
Yep, makes all the sense in the world. Great tip. Use your seller credit to get rid of the PMI. Good stuff. Good question here as well. The business loans sound like the qualifications are catered to existing investors. Any recommendations for business loans for people just starting out?
Yeah, so any of these loans will work for the first-time investor. All right, the DSCR works, the Fannie works, the bank statement works. You do not have to have a history of investing. The only requirement is on a DSCR bank statement loan that you must own a primary residence, right? And if you own a primary residence and you're actually buying an investment property, that's the qualification there. You don't necessarily have to have an investment history. If you're looking for an exception to the down payment requirements or whatever, then yes, it's required. But no, you do not have to. You can be a first-time investor. You just cannot be a first-time home owner.
Got it. That's a good distinction there. First-time investor is okay, not first-time homeowner. This one, I think, make sure I think I understand this appropriately. How available are second mortgages on STR properties? Basically, a second mortgage that helps you fund the down payment on a new property. What are there options out there? Maybe some direct money loans or something of that nature. And are those allowed with DSCR loans or any of these loan types where you can get a loan for the down payment?
Yeah, essentially what we're talking about on that seller carried is that exact strategy, right? It takes a second position on that. But no, there's no organized institutional loan product out there for an investor loan that will help you with the down payment requirements.
Yeah, got it. I think we've gotten a couple of forms of this next question. They're basically, how do we get in touch with Chris, or can we work with Chris directly if we're looking for an STR loan? Absolutely. Nicole is going to follow up with the details on Chris's contact information. We also have a special for working with Chris that I'll share with everyone in a second. Speaking of that, I know it's 1:46 Eastern time. This was supposed to be a cutoff for the webinar. I have a little bit more time to go. Chris, do you have a few more minutes to continue going through questions? We still have plenty. So everyone feel free to continue. If not, we will record this and share this with the rest of the group, but we're going to try to cover as many of these as we can in the next 10 to 15 minutes, just because we have some great questions coming in. This next one's regarding the bank statement loan. Bank statement loans could have revenue streams from many different properties into one operating entity. How do you determine what amount to use to debt service a certain subject financing property? Basically, a bank statement could have multiple revenue streams. How do you know which ones to pick to finance the property?
We look at all incoming deposits. Right? We don't eliminate for if it comes from this one to that one, it doesn't matter. It's all funneling into the same entity's business bank account. Therefore, we're using all the collective deposits to determine the cash flow and underwrite the loan.
Got it. Good to know. Some quick ones here. Are you doing any hard pulls on credit for every deal?
Yes, so we will pull credit. There will be a hard pull. That credit report is good for 120 days. So if as long you can fund as many transactions as you can get into and on one credit report over the course of those 120 days.
Good to know. I guess there's a related questions came through chat. How often can you get a loan? Is there a max? So,
There's no maximum. So what we do have an internal policy that when any individual goes over 4 investor financing loans with us, that 5 and beyond, it goes through a second review committee just to make sure that, you know, how much funding we have out with one individual or entity. We want to start to track that. And it's not so much for the number that we're looking at is about 10 million, right? Once we get to that 10 million mark, then we might actually, you know, cut it off, right? Because we don't want more than 10 million out per one person.
yep, makes sense. On the Fannie loan, is there mileage required from the home location, from your home location?
Yes, there is. I believe off the top of my head, it's 50 miles. I think it might be 50 or 100, but it definitely has to be a considerable distance away from your primary residence. And the location that you're buying this home must, you know, be a vacation destination. It needs to make sense. This is one of those loans that there's a lot of underwriter discretion on. So when they're underwriting that loan, they're going to be looking at, you know, how much of this makes sense. Like, and again, that's why it gets difficult to get your, you know, second, third Fannie Mae type. I see a lot of people trying to use Fannie Mae second home for, you know, their third and fourth properties, but then it starts to look like a misuse of that loan product. And then it really gets designated as an investment purchase in that sense, right? Because how many true second or owner occupied primary second homes does one need? So, yeah, they're gonna definitely, there's a distance requirement, and then it's gotta make sense where you're buying that property.
Got it. Yep. I definitely don't need a second or third home to spend time at when it comes to that perspective. Is it common to see a lender sell your loan to another lender after you close on a DSCR loan, or is that a red flag when looking at lenders?
That is very common, right? With these non-QM loans that we've been discussing here today, the DSCR and the bank statement, the way it funnels is these loans are sold to investment banks who then securitize them. So that servicing will change as it moves through that chain. And that's the whole infrastructure of this non-QM market. So it's going to be a common practice until, you know, servicing of these loans from maybe a lender's level becomes, you know, a thing, which I don't think is going to happen anytime soon. So yes, anticipate your loan being sold at least once. But if it goes through securitization, it might change servicers twice.
That's a good question. Good feedback. Related to that, we had a question coming about what QMs are.
QM, qualified mortgages, that's going to be your conventional loans from Fannie Mae, Freddie Mac. That's going to be your FHA or VA loans from Ginnie Mae, or FHA, VA, and USDA loans from Ginnie Mae. Those are your QM loans.
Awesome. Thank you for clarifying that. Do any of these loans have a minimum amount that can be borrowed?
Yes, the minimum loan amount on a DSCR is 150. I believe on the conventional, it'll go down as much as 75. Bank statement's going to be 150 as well.
Thank you for clarifying that. The next one is around running a pro forma on a DSCR loan. When doing so, before contacting a lender, what is a good safe discount to use? 20%, 25%, 30%? I'm
sorry, can you say the first part again?
So I've been running a pro forma on a DSCR loan before reaching out to a lender like yourself. What is a good percentage, safe percentage to discount to use on the revenue? On the income, 20%, 25%, 30%? What do you recommend there?
I'd 20%. Say, yeah, more outlets are going to be at 20%. There's a few at 25, but definitely 20 is a safe number.
Yeah. Next question. What if the property was never a rental property? Does the lender just use Rabu data?
Correct.
Yep. So if a lot of times what you see on our platform, they're not existing short-term rentals. So, but we have revenue projections based on nearby short-term rentals that's what the lender uses for their underwriting. Of course, with that 20% discount, which is normal. And what is the average DSCR APR rate at this time?
Oh, the average DSCR, I don't know, but what I will do in the information at the end of this, you're going to receive an email with 3 things from me or from Rabu. You're going to have my phone number for contact, email for contact. I'm going to have a link where you can book a call. But that question about APR is a good one. So what I'll also do is I'll have some estimates. I'll do a hypothetical, a $500,000 purchase. I'll put together a bunch of different terms. I'll estimate fees, etc. And it'll be a link. So anyone that can click on that link can view those scenarios. And then you'll see our APR in there. And that'll actually give you a good baseline of where we're at on these type of loans today. So if you are shopping, then you can look at this today. And I'll put all the details in that estimate. It's a link. You click on it. It'll have all the comparisons from all the different programs, cash to close, everything.
Awesome. I like this next question. How will this work with off-market properties that need some rehab before renting out and a quick turnaround time to buy? So how do you guys underwrite for something like that when there's some rehab involved to meet the revenue potential?
So in a situation like that, if we have a subject property that it's in need of renovation and that's called out on the appraisal, then you're not going to be able to close that transaction until those issues have been addressed. Now, what you're probably looking for in that situation is a different loan product. You're looking for a bridge loan, most likely with some type of renovation loan tied into it. And that bridge loans, they're typically going to be anywhere from 1 to 2 year terms, meaning that loan is due in 1 to 2 years. Now you do the bridge loan to buy the property, and then behind it, you're going to do a renovation loan for, up to 75%, maybe even 100% of the renovation cost. You're going to perform the renovations. Then you're either going to list it or get it rented, and you're going to cash out refi out of those terms with something like a DSCR loan.
Thank you for clarifying that. Just have a few more questions. If both options are open, conventional versus DSCR, which one would you choose?
The right answer to that question is, speaking for myself, like, I got to know you. I got to know what your situation looks like. What is your asset situation, your income? I've got to know where you're at in your investment strategy, where you're trying to go. What's your, is there a spouse involved? Like, do you got kids involved? What's your risk tolerance? Like, to be able to say one or the other, is kind of a disservice in the sense, like, it really, you have to work with someone that's going to get to understand you on all those levels so they can actually recommend the best one. If, I'll tell you, for me here today, I'm doing a DSCR loan, more likely for the sense that I'm a self-employed individual. I've got multiple entities. I don't want to pull together all those tax returns and go through a full doc process. I'd rather just put my down payment in, form my LLC and close the loan. So it's a bit of a convenience thing on that side for me, why I make that decision. But each individual is going to have their own motivations, their own risk tolerance, their own story, their own, context, which is going to determine where they should go on those loans.
Yeah, we're definitely not financial advisors. It really depends on each individual situation, your risk tolerance, and even your employment setups. But I appreciate you giving it from your perspective, Chris. Any special qualifications needed for people outside of the US?
Great question. So what you'd be talking about then is like either a DSCR loan or a bank statement loan or a non-QM loan for a foreign national. Okay, so it works Canadian, it works for Canadians in Mexico, it works, there's a list of them, but minimum down payment on a foreign national loan is going to be 25%. You cannot close in an LLC when you're doing a foreign national type program, but it does exist. You're looking for a foreign national version of a non-QM loan.
Good stuff. Any good programs for new builds that our attendees should look for if they're looking to build a new construction short-term rental? I'm assuming.
Yeah, so if you're looking for, a one-time close type loan on a new construction, and it's obviously in this context for an investment property, you're going to have the channels that will actually fund that are very, very few. Again, this is where you're getting back into regionalized hard money lenders or local regionalized privately owned commercial type banks. And you get those loans and you do your build, and then you have an exit strategy, whether that's a refinance or an exit strategy with that particular lender that's going to recast or redo that loan into some type of fixed rate long-term financing.
Awesome. And then last question for you, Chris, how long is the pre-qualification good for if you get pre-qualified?
Pre-qualifications are going to be good for 120 days. That's the life cycle of the credit report. So what I would say is, 120 days, but communicate with your loan officer on any changes, whether if it's a loan that involves employment or income. But 120 days.
Awesome. And the last question is a question for Rabu. Is Rabu capturing it's capturing its revenue from all platforms? We focus most of our data capturing from Airbnb because that's where most of the activity happens, but we definitely account for other platforms in the process as well. I think I've covered all the questions here today. Thanks everyone for joining. Love all the questions that came in. I think we had almost 30 questions come in. Chris, thank you for the time as well. I think seeing some of these comments, everyone's fun is extremely helpful. Getting lots of thank yous and a lot of people saying they learned a lot. So thank you for sharing your expertise with it. For everyone, again, thanks for attending. As I mentioned, Nicole will follow up with an email from Rabu that will have some more contact information, some of the items that Chris identified that he will share with the group. We're also going to share this recording with everyone. As I mentioned at the beginning, we are offering some specials for you guys that attended today. For those that are interested in finding the right short-term rental to buy, if you sign up for data.rabu.com and use code RABU23, you can get $199 off your annual subscription. And if you start working with Chris and theLender and you mention RABU23, you will also get a $1,000 lending credit. And as we alluded to, you'll get Chris's contact info in the email that will follow up in the next day or so. Again, thanks everyone for joining. Really enjoyed this, Chris. Awesome. Really appreciate the data that you shared and all the insight. And thank you for providing financing for this new asset class. There's not a lot of you guys out there, so thank you for doing so.
I appreciate it. I enjoy it, and thanks for having me. I hope it was informative, and I look forward to talking to everyone.
Absolutely.